So there's been a lot of talk in the community about whether the markets have bottomed or you know basically what's going to happen next with the markets and things like that. And the truth is, nobody really knows for sure. But I got this question recently from a subscriber. Just wanted me to weigh in as far as this conversation is concerned. So this video is going to be me addressing this question and basically giving my opinion about whether I think the markets have bottomed or not. But hopefully you'll stick around. Please consider liking, sharing, subscribing. Thank you guys for watching. Um, Make sure you go over to chartsandpriceaction.com and check out my latest course offering with By the Hood University, where we break down charts in a very simple way, as well as trading psychology in a very practical way. But stick around and let's talk about, whether these markets have bottomed or not. And let me know your thoughts in the comment section. So I had to go to um, my paper trade account for Thinkorswim because on the live side, my SPY chart is just so marked up that it would have been difficult for me to um, mark it up in a simple way and explain to you guys, what I'm seeing and offer my thoughts. So, and it's also, a little bit, teeny bit embarrassing because I tend to get married to my levels and my trends, and so it's just difficult for me to delete those things. But anyway, so first off, before I even get to explaining this from a technical perspective, going back to the question that was asked, I'm gonna try to define panic selling. So, panic selling is, of course, a bearish event, and usually panic selling happens after, maybe it's based on some sort of rumor, or basically like an overreaction. But basically, with panic selling, there's not really something material happening. And if you guys remember, if you were around trading the markets when Donald Trump was president, there were a lot of opportunities to make money from overreactions to his tweets and things like that. And yes, some of those tweets may have been, kind of tangible events, but a lot of those were just panic selling. It was just simple overreaction to a headline that really didn't mean a whole lot in the midst of, you know, what was really going on fundamentally in the markets and the economy. Um, and it can be panic selling can definitely be accompanied by high volume. But the major thing with panic selling is that it's not necessarily something that's really material to, a company or the markets in general. And then capitulation. And I'm defining these because the subscriber asked and specifically mentioned these things. So I want to make sure that we all have an understanding of what these concepts are. So capitulation is pretty much when all hope is lost in the markets. In this instance, something material. There is sort of like a fundamental narrative that justifies the selling. And again, like panic selling, with capitulation, you do have that high volume. But the thing about, capitulation is that you don't necessarily know it's capitulation until after it happens. But the major thing you want to look for is there's already been some selling. So sometimes you'll see panic selling and then capitulation will come after that. But um, the major thing that you want to look for is that rebound after that unusually high volume spike on pretty strong selling. But again, the nuance with panic selling versus capitulation is that with capitulation, there's usually a fundamental narrative that justifies the selling. So people from traders and investors alike, they like to try to identify these types of events. And on the panic selling side, it's like a day trader's dream, to be honest with you, because um, imagine, during the days of Donnie T, when he would, tweet out something random and the markets would just react immediately and sell off, and that volatility would spike. And I mean, you could just jump in and literally throw a dart at a ticker and make some money. Um, but again, like I said, when it comes to capitulation, usually I don't want to say that's the final tranche of selling, but usually after capitulation there's like a relief rally or something like that, but there's a bounce. So investors and traders alike, they like to try to get in um, at that capitulation event, and try to catch that bounce to the upside. So uh, again, like I said, it's one of those things where you don't necessarily know that it happened until after the fact. So just something to keep in mind. Um, let's see. Let me make sure I address those. Okay. All right. So in the question, they talked about heavy volume at the lows. And they specifically mentioned the years of the previous market bottoms in 2018 and 2020. So what I did with this chart is I went back to about the 2007 era up until present day, and I just marked the charts up and identified some key events along the way that caused some pretty strong selling. And so if you look across the time, now this is a monthly chart of SPY, and the reason that I use SPY instead of SPX is because on Thinkorswim, it does not show volume on SPX. So of course I had to use SPY so that I can reference the volume, throughout this discussion. But as you can see, the markets had a strong pullback in back in 2007, 2008, and we know what happened back then. The whole real estate bubble situation happened, and the markets pulled back about 56% at that time. And you can see that the volume, it was like really unusually high volume here, especially when you compare it with with the years before it. And then you had this really high volume spike here. Um, did I even label that? I thought I did. Yeah, okay. So you have that 2007, 2008 peak volume here, and I just messed that up when I did that. But anyway, you get the point. So here's that peak volume, that when that selling volume finally spiked here. And keep in mind that from a technical perspective, just because you get that really, really high spike in volume, it doesn't necessarily mean that, hey, the next volume bar is going to be buying. You always want to watch for confirmation. Of course, this isn't investment advice or anything like that. I'm really talking to myself and, you know, broadcasting that to you guys. But however, what I've found is that when you do have those high volume spikes, they usually are a signal, along with some other things as well. But that's one of the main signals that I look at to show that, hey, this trend is ending. So for me, I don't necessarily like to, as a trader or an investor, I don't like to get in when the volume spikes. I like to get in before the volume spikes. And when that volume finally spikes, that's when I want to be getting out of my position. So just something, just a little piece of information to consider. All right, so this next major event was in when was this, 2011? So in 2011, the markets pulled back about 21%, and that's when that was the whole debt ceiling, credit rating crisis. So when the U.S. Their credit rating got downgraded, and the market sold off. And then in 2018, the markets pulled back about 21%, and this is during the Trump era, and this is pretty much, in the midst of the U.S. versus China trade war, and also the Federal Reserve had talked about possibly tightening, going into a tight monetary policy. So the market sold off as a result of that. So there was nothing, and if I remember correctly, at this time there was nothing really material happening. This was just kind of like a reaction to a headline because, well, actually, the Fed did try to raise rates, and they ended up shifting course. So let me delete that. Don't even listen to that what I just said. So the Fed did try to raise interest rates, and the markets could not handle it. So they went back to that more loose monetary policy and took those interest rates back down. And you can see the markets recovered pretty quickly. And then COVID was 2020, and the markets pulled back about 36% over the course of 2.5, 3 months, and it just kind of blasted off. In the most recent situation that we've seen over the past several months, the markets only pulled back 25%. But you got to think about what's going on at each step. So basically from 2020 to present day, we've been dealing with Fed shifting their monetary policy to from QE to QT, pandemic. The economy's running hot. I mean, if you think about it, for all this time, for almost 14, from 13, about 13 to 14 and a half years, interest rates have been pretty much at zero, right? So that the Fed pumping money into the economy is what caused the markets to run so hot and run so hard for all this time. And really, this move here was not really sustainable. So when you get those kind of exponential moves, they can only last but for so long. And so what we're seeing so far is not necessarily a change in the long-term trend. We're just seeing another kind of little pullback along the way. And as you can see, the price came right down to around that 23.6 fib level, and it's bouncing from there. It's been bouncing over the past couple of months. If you look back to this 2011 event, you see that volume spike, so that unusually high volume, and it spiked along with that. And you can see when it happened toward the end of that move, right? We go to the U.S.-China situation. Volume was above average, but it wasn't necessarily like really unusually high in the grand scheme of things. So I won't say quite a bit of volume, but it was above average, but not just towering high above the volume of times before. And then 2020 during the peak of the COVID situation, or the height of the COVID situation, this volume, we did get an outlier type situation with the volume spiking pretty decently at that time. And as you can see, that happened on the very last bearish candle of that that move, that down move. So just again, something to keep in mind. This blue trend line just kind of helps put a visual on the market tops from 2008 up until November of 2020. So what we see is that every time the markets or SPY would hit this trend line, it would it would kind of pull back a little bit, right? And so when COVID happened, it pulled back pretty hard down to support. And then in November 2020, it finally broke out and went to new all-time highs. Just crazy, crazy, crazy run from 2020 to 2021, late 2021. And as you can see, it bounced pretty much right off of that support or that old resistance, kind of confirming this trend line as that new long-term support. And I'm gonna get rid of this fib because I just wanted to kind of show you guys pretty much where it pulled back in the grand scheme of things. But anyway, so pulled back and confirmed that old resistance as the new support for now. You see, I have that labeled as 2008 to 2020 resistance level. Um, right now, in my opinion, uh, most recently anyway, a lot of people put a lot of weight on this recent CPI number that came out Wednesday. I think it was, yeah, Wednesday. And they're saying, bulls are taking control of the narrative and things like that. When the truth is, in my opinion, my very humble opinion, nothing really has fundamentally changed in terms of the overall economy. Yeah, gas went down a little bit, food went down a little bit, but those are like the most volatile parts, pieces to the puzzle when it comes to calculating CPI. Um, but if you look at the core numbers, they're just kind of flatlining right now. From July to or from June to July, the numbers didn't change. So now it's like, okay, what is the Fed gonna do now? Do they continue to be aggressive? Because they for sure can't, um, they can't cut rates. You know what I'm saying? They can't cut rates because at this point, from what I've been seeing, wage wage growth and stuff like that, wages are still strong. They're putting on this face that consumers are still, they're still strong in terms of finances and things like that. So they can't really cut rates at this time. You know what I'm saying? So that's a piece of it, to think about. Do they go with a softer rate raise coming, or do they stick with the 75s and say, hey, the 75 is really getting it done, or it really got it done with doing those two 75 basis point hikes, or they say, do we need to lay off the gas a little bit and just kind of let things just see how things go or happen over the next several months. So we'll see. We'll just see. Uh, Another very important thing to keep in mind is the whole political part of this. No president wants to have a recession on their hands. You know what I'm saying? So keep in mind that midterm elections are coming up in a few months. So I think the markets tend to run heading into uh, midterm elections. So that's another thing to keep in mind. So they have to keep up this narrative that, hey, the Fed is being aggressive in fighting inflation, and now look what's happening. Inflation is coming down. This monumental bill that's just got passed that's going to help bring inflation down and things like that. So, they're trying to lay it on thick right now to keep America confident in the system. And, that's my humble, honest opinion. Um, but those of us that really pay attention, um, not just in this political arena or anything like that, but you're paying attention when you're swiping your card or spending your cash or traveling. You're paying attention. You see how you see how you're being impacted. We're on the front lines. So you can form your own opinion, based on that, and nobody can, really dispute that. You know what I'm saying? Um, so that's pretty much it, from a fundamental perspective that I wanted to, point out in this whole situation. But from a technical perspective, even and fundamental too, I do not think that the markets have bottomed. I just think that, this is just kind of that first leg down in a bearish move. But I just sort of watch for key levels to break or hold before I really form an opinion about whether who's in control and things like that. Long term, of course, the SPY continues to be bullish. Um, and I pretty much showed you guys how the bullish trend has remained intact, even with COVID, even with the credit rating, debt ceiling crisis, even with the stuff that happened in 2007, 2008 with real estate, trade war, COVID, quantitative tightening, recession talk. This long-term trend continues to hold. But this is the trend line that I'm really, really, really going to be watching. What I'm calling the 2008 to 2020 resistance that is now has been confirmed as support, as I stated before. But there are so many scenarios that could happen right now. The markets could run back to that all-time high and maybe even set a new all-time high. But in my opinion, that still doesn't change the fundamental narrative. You know what I'm saying? Um, so a lot of price action, well, pretty much price action is human psychology. It's not just sound investors and traders making sound decisions based on fundamental things. It's also the emotional piece of it where, people are trading and investing based off of how they feel. And so you have to keep those two things in mind when you're evaluating the market. So pay very close attention on a macroeconomic scale and a micro as well, um, to what's being stated in the news, what you're seeing and hearing from these companies. Make sure you get on some earnings calls and things like that, just to hear the outlook from a lot of these companies. And like I said, it's nothing is changing right now in terms of the fundamental narrative. So while you may look at some data and say that, and they say that, you know, job growth is too strong to be in a recession right now. But if you look at it, I think recently it's kind of started to taper off. That job growth has started to taper off. So um, they won't admit to a recession. They won't admit to the U.S. being in a recession until the recession is over. So also keep that in mind. So maybe at that point we'll see some capitulation. So just be looking for that. Spike in volume, maybe some panic selling to that happens beforehand. I don't know, but like I said, this is just we got a little retracement to the about the 23.6% level, and it's headed back up. It may or may not head back to that all-time high. And if it does, heading into the end of the year, um, there's still some bearish scenarios that could be at play, right? So we could have what's called a double top, where what happens with a double top is the price could come back up here somewhere and then reject this level again and head back down. So that's a possibility. You know what I'm saying? But again, I'm watching this trend line. That's kind of sort of like my first line of defense type of trend line, where I'm determining or thinking about who has control of the narrative. Um, but in my opinion, I don't necessarily listen to the talk that uh, are bulls taking control of the narrative, you know, um, or bears taking control of the narrative. I'm just thinking about things from the perspective of what's going on in the economy, and what is more likely to come. Um, I hope to not see a situation where the Fed backs off of hiking interest rates. I think that they should have kept with it in 2018. And then at this point, we'd be talking about, how the markets are recovering at this point. But instead, we're kind of at the front door of the situation. But I don't make those kind of decisions. But so that's a possible scenario, is maybe a double top forms. But again, this is just that first leg down, and we're getting a bounce here. So maybe we get some sort of relief rally heading into the midterms. Um, but I think that one of the next levels that I'm really, really looking at is this 430 to 433 level, because I think that SPY and SPX have yet to get back above their correction level, so they're more than 10% down at this point in the game still. Let's see. Yeah, yeah. So getting close to them, but last time that Spy pushed to that area, it failed, as you can see here, and it came down to this historical level. So it's headed back there again, and either the Bulls push it above that level and hold it, or the Bears step in once again and push this thing down. So I think that this is just one of that little first leg here on the monthly chart, and maybe this is like a little relief rally type situation happening on Spy. And as far as the volume is concerned, the past several months here, we've seen a little bit of elevated volume, but definitely pay very close attention to volume. But it's been kind of tapering off here over the past about 4 or 5 months or so. So you can see that July was strongly bullish with below average buying volume. So um, there's not a whole lot of conviction, in my opinion, from a volume perspective, that I'm seeing right now. So um, let's take a look at the weekly chart and see what we can see here. All right, so I got the 5 year. Yeah, I got the 5 year here. So you can see a bit better those pullbacks and kind of where they happen in relation to those historical trend lines that I drew. And again, price just bouncing from that old resistance, confirming it as support for now. And it's just a leg down here, just a leg down and a pullback, and we'll kind of see where things go from there. Matter of fact, I'm gonna just put a little fib here. Let me go to 3 year. All right, so if I put a fib here, let's take a look at some levels. All right, so pretty much sitting right there at the 50% fib level. So pretty much your major fib levels are going to be 0, 23.6, 38.2, 61.8, and then that 100. Those are some of the more popular ones that are used. But here are just, some levels to consider, or at least some that I'll be considering. And that 61.8 level is really, really, really important because it's right near or just north of that correction level that I mentioned, between about 430, in the low 430s. I don't remember the exact number, but just subtract 10% from that 479.98 number, and there you have it. So yeah, so we're just getting a little retracement here. Not necessarily a change in trend officially yet, in my opinion. But I'd be looking to see if the Bulls can push this thing up and over this 61.8, and see what happens there. That's pretty much, short term, the level that I'm watching, really. And if it can hold there, it can certainly get back up to that all-time high, in my opinion. At which point, like I said, I'd be watching for a potential double top, or any sort of change in the narrative in the political arena, or the macroeconomic arena, to see if this move is sort of justified for the markets to be hitting new all-time highs and things like that. But based on what I've been reading, what I've been seeing in the news, what I'm seeing at the pump, and what I'm seeing everywhere that I swipe my card, the economy is super weak, and it's not uh, doesn't seem like it's gonna get strong anytime soon. You know what I'm saying? So that's pretty much my opinion. I don't think the markets have bottomed, but for me, it'll take really a fundamental change in the economy, for me to believe that it's possible that the markets have bottomed. But even from a technical perspective, um, anything can happen, and I just try to be as neutral as possible and just play the levels, and piece that together with what's being stated in the markets, what's being stated about the economy, and things like that. So I humbly suggest that you guys do the same thing, and just kind of keep an eye out on some of these major levels, and keep proper context, because a 25% drop in the markets will seem like, oh my God, that's catastrophic. But then you pull up the monthly chart like I just did, and you see that the overall technical picture is still intact. The Bulls weren't even able to push this thing down below that old resistance from 2008 to 2020. But hopefully this was helpful for you guys. Hopefully this answered Coffee's questions. I appreciate you guys for watching, and I will certainly catch you in the next video.